Hello everyone, welcome to our today's live session. Today we are going to talk about Dow Theory, another important segment of technical analysis. Basically, the Dow Theory marks the beginning of the technical analysis that we know today, and we're going to go into more details and explain how it works and what are the major premises of the theory. It's very interesting and it's very important, and basically it's the beginning of the technical analysis that we know today. Charles H. Dow was the founder, and he developed this theory, and he got a number of useful conclusions that were helping to develop further during the years the current technical analysis that we know today. So it's basically an approach to trading in analyzing the market movements developed, as I said, by Charles H. Dow, and that his studies mark the backbone of what we know today as technical analysis. The Dow theory is basically the analysis which says the market is in uptrend if one of its averages, industrial or transportation, advance above previous important high and is followed by similar advance in the other average, and vice versa. So basically he's recognizing the trend based on the his indices that he developed, Dow Jones Industrial Average and Dow Jones Transportation Average, and basically the trend is defined once that both averages advance above previous important levels and create new highs, and series of new highs and higher highs and higher lows basically define the trend in the upside, and on the opposite direction series of lower lows and lower highs define the downtrend. So this is one of the most basic explanations. What is it? So Dow was actually trying to define the trend by behavior of two key indices, Dow Jones Industrial and Dow Jones Transportation Averages, which proved to be quite useful. And at the end, it resulted in Dow Theory. Unfortunately, Dow died and did not write the book, but his associates and successors continued his work developing further the theory, and eventually published the book. The history goes back to the late 19th and the early 20th century when the theory was developed by Charles H. Dow, and he was publishing his ideas in essays that he wrote and published in the Wall Street Journal, as Dow was also one of the co-founders of the newspaper. So he had a place where to publish his opinions, and a number of these articles were basically published at that time in the Wall Street Journal. The theory, after his death, was developed in the next 100 years. Some aspects have lost ground during the time, but overall approach of Charles Dow remained and marked the backbone of technical analysis that we know today. Dow published the first stock market average in 1884. It's composed of the closing prices of 11 stocks, which include 9 railroad, transportation, and 2 manufacturing companies. And he estimated that these stocks provide a good indication of the economic health of the country, as his main rule was what industrials make the transportation take. So basically, if the industry is doing well and the production goes higher, the transportation will of course follow, and this will be beginning of the trend, in this case the trend at the upside. Further, in 1897, Dow determined that 2 separate indices would better represent the health of the economy if adding some more stocks in the index. So it ended eventually with 12 stock industrial index and 20 stock of rail index, and further development by 1928 in the industrial index, which is known as Dow Jones Industrial Average, had grown to 30 stocks which is the today's number of Dow Jones. So it consists of 30 significant stocks traded in the New York Stock Exchange, representing the value of 30 large publicly owned US companies. The Dow Jones Index represents the sum of the price of one share of stock for each component company. So basically, to get the index price, you have to add the price of the one share of each stock to get the the current value of the index, and the sum is of course corrected due to for several factors like stock split or dividends. So they included the factor which changes whenever these things occur. So it smooths basically the price action of Dow Jones index. Unfortunately, as I mentioned at the beginning, Dow never wrote a book. He had a number of articles published in the Wall Street Journal, but no book with his theory. But the theory, his articles presented his ideas of stock market behavior, and were used by his colleagues and associates, which continued his work. Dow died in 1902, and his associate S.A. Nelson collected all these articles that Dow published in the Wall Street Journal, and published the book named the ABC of Stock Speculation. The book which first time mentioned basically the Dow Theory, and this is a sort of beginning of official Dow Theory publication. Further down in 1922, William Peter Hamilton, another associate of Charles Dow and successor in the Wall Street Journal, categorized and published all the principles of Charles Dow in a book called The Stock Market Barometer. So further improvement, as I mentioned at the beginning of the session, that his successors continued to improve his initial ideas, but generally what Dow invented, it stayed as a core of the technical analysis, and whoever was continuing was using the main premises of Dow theory, just adding some new value, adding values of the new things that were improving further the Dow theory. And finally, another successor, Robert Reif, further developed the theory in the book named the Dow Theory, which was published in 1932. How Dow watched the market? He compared the market with the sea, with the ocean. And let me read this for you. A person watching the tide coming and who wishes to exact spot which marks the high tide, sets a stick in the sand at the points reached by incoming waves until the stick reaches a position where the waves do not come up to it, and finally recede enough to show that the tide has turned. This method holds good in watching and determining the flood tide of the stock market. This was published in Wall Street Journal in January 31st, 1901. And basically, this is the explanation of something that we're going to talk about in today's class. So basically, he compared the tide of the ocean with the market movements and had a very good point with these things, as same principles that work in the sea with the tides and waves apply to the market also. So how it works on the chart, we can see the beginning of the uptrend. Basically, we have the move to the downside. We have a low. Then the market recovers to the certain high and then pulls back to the higher low. It's important that this low is higher than the previous one. Move above the first high is a buy signal. So we have the beginning of the trend, and then we have confirmation of the uptrend, which continues. Of course, the market doesn't move in one straight line, has its waves up and down, but this confirms buying signal for the certain stock or asset, and the market continues to move higher. And basically the trend consists of a series of higher highs and higher lows that determine the trend. In this case, it's an uptrend. Once the trend gets exhausted and reaches the peak, corrects lower, we still don't know whether it's going to continue higher or move lower. Important point is this recovery high. If it's lower than the previous high, this is our initial signal that the market trend is about to change. So what we are watching now is the latest low, the latest higher low. If the market price accelerates and breaches this low, this is signal that the trend is reversing. So we have now selling signal here. So basically, these are the principles of Dow theory. It accompanies a number of other studies that were developed later on. In this case, we have a clear head and shoulders pattern and reversal below. If we draw the neckline, it will come somewhere close to this line, so we'll have similar signal. So this confirms that Dow theory is the core of the today's technical analysis, and the number of known studies of technical analysis have roots in the Dow theory. And now another one, how it works exactly with the Dow Jones two averages. You can see that a green line presents Dow Jones Industrial Average, and the yellow one presents transportation average. So what we have the highest point here, and then the market moves and hits the low. Recovery hits the high with both indices moving parallel. So this is the principle that if there is a trend, then both averages will move together. Otherwise, there will be signal of most likely trend will not be established, and there will be other direction. We hit the next recovery high, which is lower than the previous high, and finally we move lower below this low, and we get our selling signal here. So basically, very simple principles that work very good in the markets. So now let's see the chart of Dow Jones future contract. So we have initial move higher, and we reach certain high, which limited the movements further. The market corrects lower on the pullback, hits the low, then tries to recover again. The highs of the next leg higher are lower than the previous high, and then we have fresh attacks at the low, at previous low. So once the market breaks this level, we can see the chart that already happened. So basically it works. It gives us a signal 1, 2, 3, and the fourth finally is break and sell signal. So we have breakdown to the lower, changing from the uptrend to the downtrend. And the points that are high, low, higher low, lower high, breach of the lower high, higher low, and the sell signal. Same thing applies on the opposite direction, where we have the downtrend that hits low. There is corrective bounce limited somewhere. Fresh attempt lower. So far it looks like a correction of this previous downtrend, but the fresh weakness runs out of steam above the previous low, and this is our initial signal, which will need confirmation on the breakout level above the previous recovery high. So we have bullish signal, and as we can see, it happened exactly. The market went higher, and they changed direction. Now we can recognize another chart pattern here, double bottom. So we have initial Dow theory could be transformed into the nowadays technical analysis tools, which say that double bottom is a bullish reversal signal, and suggests that the market will likely change direction from the existing downtrend to the uptrend. So it shows how it works. Now we have a number of points that are very important, and basically they are the main components of the Dow theory, and Dow put them in the 6 main tenets that are the key of his theory. So the first one, market discounts everything, meaning that market action, price action, includes already all factors that are coming from outside, so that there is no surprise. Market reflects every possible novel factor that affects overall supply and demand. Is one of the basic premises of Dow theory. So it applies to various factors such as moving averages, earning potential, competitive advantages, management competence, and many more factors that are already priced in the market, even including the future events. So we can say that whatever market moves, the price action already discounted all other factors that are important that they may influence the market action. The second one is the market has three trends. So the Dow was pointing at the trend, recognizing trend, and then breaking it into pieces to see how it functions, how it works. So we have time to analyze this trend and to predict how long it will last. So it will at the end give us opportunity to increase our profits in trading. So Dow defined an uptrend as a situation in which each successive rally closes higher than the previous rally high, and each successive rally low closes higher than the previous rally low, marks an uptrend. So this is what we talked about previously. And we can see series of higher highs and higher low define the uptrend. Conversely, a series of higher highs and lower lows define the downtrend. So this is the second of the key points of the Dow theory, and an uptrend has a pattern of rising peaks and troughs. This is what we just said. So series of higher highs and higher lows define the uptrend, and the series of lower highs and lower lows mark the downtrend. So successively lower peaks and troughs define the downtrend. Also, the Dow considered a trend to have three parts: primary, secondary, and minor. It's important to see this as traders can recognize these phases and find the optimal time to enter the market and increase possibilities of increasing their profits. So primary trend represents the major direction which lasts more than 1 year and could possibly extend to several years too. So this is the general direction of the market. I will show you now in the chart how it looks. So basically we have this major trend, and we can define it by the trend line. So the trend stays intact. Trend lines are hitting, the market's hitting lows, leaving the troughs, actually the higher lows, and they are supported by the trend lines. So we have the major trend. Secondary trends often work against the primary trend and mark pullbacks. So we have the primary trend and we have number of secondary trends which are corrective nature. So we have one correction, the second correction, third correction, fourth correction. So number of series of corrective actions. As we said, the market does not move in the straight line, but moves in the waves. So the secondary trend it marks corrective phases, and they usually last 3 weeks to 3 months, while major trend or primary trend lasts more than 1 year and could extend even to several years depending on the financial asset. And the secondary trend lasts 3 weeks to 3 months. And finally, we have a minor trend that lasts less than 3 weeks and mainly represents noise. Noise is are the movements that are not, let's say, realistic. So they are just these spikes that come out of the movement, and they present the minor trend, which lasts less than 3 weeks and is a part of the secondary trend action. Now, how it works in the Dow theory. Dow was, as we mentioned previously, was comparing the ocean and tides in the ocean with the markets. So he compared these three trends with tide, waves, and ripples of the sea. So the primary trend represents the tide. So when the tide comes, it gradually moves, but moves until it hits the point where it ends. Secondary trend represents the waves. So the sea comes to the shore, sometimes hits higher, sometimes lower. These are the waves, and the ripples on the waves mark these minor trends, which are less important. In this case, we are focusing basically on the primary and secondary trends as our key things. Now, the number 3 trend is primary trend have 3 phases. In the bull market, we have first phase, which is accumulation phase. The second one is participation or big move. And the third one is an excess phase. So what is important, the Dow focused his attention, as I said, on primary or major trends, which he felt usually take place in 3 distinct phases, as we said: accumulation, public participation, and distribution or excess phase. And the accumulation phase basically represents informed buying by the most investors. If the previous trend was down, then at this point, these investors recognize that the market has assimilated or so-called all the so-called bad news. And the public participation phase comes where the most technical trend followers begin to participate, and occurs usually when the price begins to advance rapidly and on business news or improved business news or economic indicators. And finally, the distribution phase takes place when the news start to become increasingly bullish. Economic news are better than ever, and the speculative volume and public participation increase. During this last phase, the same informed investors who started to accumulate near the bear market bottom, they begin to distribute before anyone else starts selling. So let's see how it looks in the chart. So we have the first phase when the market starts changing direction. So it's accumulation phase, and the number of investors that are more aggressive, let's call it this way, would enter long positions. In this case, they recognize that things are changing before having a clear signal. So our clear signal will come somewhere here, according to the Dow theory, as we have a low, then the high, the higher low, and then breach of this high is coming. So the first phase is accumulation phase, when the number of traders are already in, and the increased demand boosts the price of the asset, and it goes higher. Now it comes to public participation. As we mentioned, technical traders who got signal from the technical analysis. In this case, we can use either Dow theory or any other technical analysis tool, will give us good information. So we have signal here, and then this is the public participation, which causes the big move. Now, at the end, there is when the market gets close to become exhausted, and as I said, the number of extremely good news start coming, and then we have this choppy trading here. So number of traders that were not sure or were looking for some corrective action to enter market start entering on this upbeat news, while those who entered first in accumulation phase already start selling their liquidating their long positions, taking profit. So they push the market lower, and then it could result in the change of the trend. The second situation in the bear market, we have distribution phase, when the people start selling in the early stage of the beginning of the downtrend which is forming. So more aggressive traders jump into the market somewhere here, which is quite high, and we still don't have clear signal. Then we have the public participation phase, when the most of traders are in on the technical signals, which should be somewhere here. And then we have this move lower, and then panic phase when the market hits a low, and most of traders assume that is going to go higher, as the market made several corrections during the move, assuming that this would be one of the corrections. And then panic phase comes when the market starts moving higher, as those who were buying or selling first are re-entering market in the opposite direction. So they got rid of their short positions in this downtrend and are entering market in the fresh uptrend. So panic phase comes with those who were short in the downtrend, and usually those who entered late, expecting that market would go higher after deeper correction. So they made a mistake, and then finally they entered at the lower levels, and the panic reaction comes when the market starts moving. The next one of the key premises of Dow theory is that averages much confirm each other, or indices much confirm each other. As said, Dow used two indices, the Dow Jones Industrial Average and Dow Jones Transportation Average. If business conditions were healthy, the rise in one index will be followed by the rise of the other one. So if the industrial average goes higher, the transportation average is likely to follow it. And this is in case of healthy economic or business conditions. But if the one average starts moving higher and the other one doesn't follow or moves lower, there will be no signal of trend, and that trend that is attempting to establish would not be sustainable. So there will be likely no trend in this case. So we have to see that both averages are running together, either in the up or down direction, regardless to a direction, but they must follow each other. As we mentioned at the beginning, whatever the industry produces, transportation takes. So basically, if there are healthy conditions and the industry and manufacturing is producing, transportation will have enough goods to take and move them further. So both indices must follow each other and must run together. Otherwise, there will be strong sign that the trend will likely not establish in this case. The next important is the volumes must confirm the trend. So basically the market moves on the main premises that depending on the supply and demand. So volume need to increase if the price is moving in the direction of primary trend. So if the price goes higher, meaning that there is stronger demand, a stronger demand represents higher volume. So more buyers increase the volume of the market. And the volume should increase if the price is moving in the direction of the primary trend, while volume will decrease if the price moves against the direction of primary trend, meaning that the price is changing its direction, generating initial signal of changing direction. So it becomes, let's say, in a way dangerous for traders. So they should recheck their positions. So important thing is also that the volumes must confirm the trend. So if the trend is going, let's say, to the upside, then the volumes must remain high because of number of participants entering the market and buying, increasing the demand, so automatically increasing the volume. And finally, what we have is the trend persists until a clear reversal occurs. Reversal in primary trends can be confused with secondary trends. This is what we spoke about previously, that a primary trend lasts for a certain period of time and has a number of corrective actions. So the Dow theory suggests caution and suggests that any change of the trend must be confirmed. So if we don't have clear confirmation, now we come to the point where the technical traders enter the market compared to those who are entering early. So they are in a way ignoring the technical signals, not waiting for technical signals. They jump in the market. Now, reversal, when it occurs, it must be confirmed. Otherwise, it could cause trader to get stuck into the wrong direction or the wrong foot in certain direction of the market, and this could result in the heavy losses. That's scenario that we are always trying to avoid. So we have the minor trend, and we have quite deep corrective actions. This could mislead us at any time, saying that, let's say if we take a look of this move here, the corrections are quite shallow compared to this one. So this could mislead, because we have signal, we have high, we have a lower high, we have low and breach of the low. So this is subtrend. This is the secondary trend, which is still corrective. Still no signs of trend change, of a general trend change. So what Dow suggests is that traders must be very careful, very cautious in these situations, not to be tricked or misled by signals that come. Strong confirmation comes when we have all technical points confirming that market is reversing direction. So we go further. There was a deep correction and further bounce, again correction, and the market continues to move higher. So the trend is still intact. The trend still exists and has so far no intention to change. So let's put it this way. And then it starts slowly changing direction, but still we are still lacking firmer signals that trend has changed. We have the trend line, and it goes above and below the trend line. So we have something like signal that something might happen. Now, we reached a certain high here and a deep correction, so deep secondary trend, and that left a higher low than the previous one. So we are still okay with our principles of Dow theory. The next move was the higher than the previous one. And then the signal basically comes on the break below this level here. So the trend has confirmed that is changed. And as we can see, the trend lasted for quite time, and the confirmation of this. Of course, more aggressive traders would jump in and play carefully with the tight stops, so it will try to prevent any damages in case the trend continues in its original direction, but would likely increase their short positions once they get clear bearish signal, so reversal signal. So the main trend has changed and reversed, and we'll be looking now for the direction of the fresh downtrend. So we got the confirmation that initial bull trend has changed to a downtrend, and we'll look how long it will last. So if we go further, now this is again stronger correction. What we have here, we have again, according to Dow principles, we have a low, we have correction, we have a higher low here. Now we are going to see how it will work further. But so far, if we apply now studies that we already learned about, which are derived from the Dow theory, then we have Fibonacci levels, very useful tool that shows us that the recovery struggles here at 38.2% Fibonacci retracement, which is one of the pivotal points. So what we need is break above this level to confirm reversal. We can add some other other studies here, pardon. Let's see how the Ichimoku studies work. We have an obstacle from the top of the falling daily cloud. So this is another problem for us that may become serious if the market continuously if market fails again at this level. So we have 38.2%, slightly below is the cloud top. So we still lack confirmation of the reversal. Let's put something else. So whatever we learned so far, it will help us to get clearer information and get more information whether the trend is changing or not. So we have moving averages in slight bullish alignment, but we have flat momentum, which tells us that the price action is lacking momentum to continue, so it may struggle again. We have relative strength index also in sideways mode, so another signal that the market is lacking strength and lacking momentum, and basically the price action is in the sideways mode during this period. So we need more signals to get clear confirmation of the change of the trend. So these are the basic premises of the Dow theory, which is one of the important things and could help us at least to learn how it works, and then we will recognize a number of we will recognize the Dow theory in a number of modern technical analysis studies, which are basically derived from the Dow theory, as Dow theory was the core of today's technical analysis. I would like to thank you all for your attention today.